Hi everyone, I'm Sabrina.
And I'm Jonathan. We're the lawyers at Varity Law.
Recently, many people are concerned about the rising mortgage interest rate. Myself and our clients are really affected by this.
But don't worry, today we will talk about 3 things you can do. You can get a new mortgage with the same bank like Mark, switch to a different bank like Kathy, or sell your property like Jay. Disclaimer, in those case studies, we have changed the details of our clients and their banks to protect their privacy.
So let's start with Mark. In 2018, Mark got a mortgage with Violet Bank at a fixed interest rate of 3%. In 2023, his mortgage is up for renewal, and the bank is telling him that he can get a 5% fixed rate, or he can get a variable rate of prime plus 0.5%.
5% fixed rate means Mark's interest rate will remain the same during its term of 5 years. Mark is unaffected by any changes in prime rate during this mortgage term. At the same time, if the prime rate goes down, Mark will not benefit either, so a fixed rate offers predictability.
If Mark decides to go for the variable rate, which is prime plus 0.5 instead, you will be completely different. If the prime rate keeps increasing, Mark will suffer. Currently, the prime rate is 7.2%, so prime plus 0.5 means his interest rate will go up to 7.7%. That is much higher than the 5% fixed rate. But at the same time, if Mark is lucky and prime goes down to 4%, then his variable interest rate will be 4.5%, which would then be lower than his fixed rate.
Now, once Mark makes a decision, he should immediately notify Violet Bank in writing, at least 6 months before his mortgage matures. That is when the bank sends Mark a renewal form. If he ignores this form, his mortgage will auto-renew on whatever term is on the renewal form. This means he could be taking on a mortgage with a much higher interest rate. So, 6 months before, Mark should contact Violet Bank in writing and say, "I want to renew with you at a fixed or variable rate. Please send me a new mortgage contract to sign." Mark should review this contract with his lawyer.
All right, so next, we got the case of Cassie. Cassie needs to renew her mortgage in 2023. However, she's been unhappy with her current Daisy Bank. She wants to switch to Lily Bank once her mortgage matures.
But here's the catch. Kathy must ensure she switches right at her maturity date, not before, not after. If she switches before, Daisy Bank would charge her a prepayment penalty, which is usually 3 months' interest. If she switches after, she misses the deadline to pay back the outstanding mortgage, resulting in more interest penalties and bank fees.
Exactly. So let's say the mortgage maturity date is June 1st, 2023. Cassie must pay back Daisy Bank on exactly June 1st, 2023. Let's say she still owes $400,000. So she should get her real estate lawyer to close the new mortgage with Lily Bank and receive this $400,000. Then, on June 1st, the lawyer should use this money to pay off Daisy Bank. So now, Cassie only have a mortgage with Lily Bank, and there is no more Daisy Bank.
If Kathy did not switch banks on the maturity date, but decided to switch before, then she'd have lots of prepayment penalties. This penalty isn't always 3 months' interest, but could be much higher, in the tens of thousands of dollars, in fact. The general rule is, the earlier Kathy breaks her contract with Daisy Bank, the more penalties there are. So, if she breaks her contract within the first year of a 5-year term, her penalties would be really high, such as $30,000, depending on how much money she borrowed, for example. But if she breaks her contract in the last 3 months of her 5-year term, then the interest penalty would just be 3 months' interest.
Another thing, Cassie and her lawyer must ensure the mortgage from Daisy Bank is actually discharged. What happens often is that the bank will leave the registered mortgage on title to your property. They do this because they will offer you a line of credit or a new mortgage. Cassie should check with her lawyer to confirm once she pays off the mortgage, the registered mortgage is actually removed. If it's not, then Cassie will have both Daisy and Lily Bank's mortgage registered on title. This will make her future refinance and sell much harder.
Next, let's look at Jay. Due to the rising interest rate, Jay can no longer hold on to his investment property and decides to sell it.
Now, Jay, you gotta be careful. If you sell your property during the 5 years contract with Lily Bank, that means you ended the contract early. You must pay the prepayment penalties. So try to set your sell closing date as the same as your mortgage closing date.
Also, is selling really a good idea for Jay? Would Jay be able to buy again if the interest rate doesn't come down?
But sometimes Jay may have no choice. If he misses the mortgage payment for more than 15 days, Lily Bank can sue Jay and his property and sell his property. This is called a power of sale or foreclosure.
Most banks will usually wait after 6 months of non-payment before starting litigation. They can also take rent from Jay's tenants, if their lawyer registered an assignment of rent when Jay got the mortgage.
Now, if Lily Bank started litigation and start to sell his property, Jay should sell his property himself instead. Because when the bank sells his house, Jay is responsible for paying all of their legal fees, broker fees, appraisal fees, and any other fees. So it is always much cheaper for Jay to sell his own property than for the bank to sell it.
Although Lily Bank will try to sell the property for a good price, they do not have to put the property on the market for a long time. Banks want the missed mortgage payments now, so they will likely pick the highest bidder within a few weeks or 1 month of listing the property.
So what happens after the sale is completed? Well, from the money of the sale, the bank will take the mortgage and service fees owed to them and give the rest back to Jay.
But if Lily Bank sold the property in a rush for $800,000, Jay would not get anything after the sale.
To prevent this, once Jay receives notice that Lily Bank is selling his property, he should immediately sell it himself and notify the bank. This way, he can sell for a good price and get his down payment back. He can also avoid the bank's legal, broker, and service fees.
Lastly, we want to touch on estate property. Many people do not know this. While you can use your will to pass on your property to your beneficiaries, you cannot pass on your mortgage.
Now, this might be shocking, but the reason is because mortgage is income tested. So your income is different from your beneficiaries. That's why the bank won't give them the same mortgage. This is a business decision made by the bank and not a legal decision.
Thus, if you don't think you can pay off the mortgage during your lifetime, you should choose from the 4 options.
The best option is if you have life insurance or RSP TFSA with designated beneficiaries. Your beneficiaries can get those money right after your pass. So if those money is enough to cover the outstanding mortgage, then they will be fine.
Second option, you can set up joint accounts with your beneficiaries. Once you pass, they will immediately inherit the money left in your account. Do be careful here. With joint accounts, your beneficiaries can access the money the moment you add them as joint account holders, not when you pass. In contrast, with life insurance and RRSPs or TFSAs, they only get the money after you've passed.
Another option is for your beneficiaries to sell the property and use that money to pay back the mortgage. They can keep whatever is left after paying out the mortgage.
Last option is for the beneficiaries to reapply for a new mortgage under their name, but they must do so before the bank starts the power of sale, so they won't have a lot of time to shop around, and they must be income qualified for the mortgage during the year you pass.
In summary, the 3 options against the rising mortgage rate: number 1, you can sign a new contract with the same bank, but ensure you understand the difference between fixed and variable interest rate. Number 2, you can switch to a new bank, but do be aware of prepayment penalties of your old bank. And number 3, you can sell your property before your bank does.
Now, many people do not know about the hidden fine print, but they could lead to huge losses. Ensure you review this video or book your first free consultation with us.
All right, that is all for mortgage interest rate. We will see you in our next month's video.